Hi, I'm Chris Levy, technical partner at Aquila Super. The next sort of brief web session that I'm doing, just in this sort of series to just try and help accountants, get the audit done faster, relates to loans. The lending of money from the fund to other parties, and it includes things like mezzanine finance. Look, I must say, I've definitely noticed a rise in the popularity of these, in superannuation funds. Partly I think because the higher interest rates, not so much now, but historically interest rates have been extremely poor on standard term deposits. So people who want something at the more risk-free end of the curve, of the investment risk curve, they'll sort of stretch a little bit outside their normal investments and go for loans of various descriptions. The other aspect too is that there are increasing number of promoters or managers, I guess, that have very professional. They've sort of put this almost like sort of like platforms and it makes it easier for investors, self-managed super fund investors, to invest in these mezzanine finance type products or loan products, commercial loan type products, it's just made the whole process simpler and led to this popularity. Now, having said that, such loans obviously it raises the risk. There's a higher risk profile of these from the point of view of the auditor. When you're lending money to a bank with a term deposit, well, that's great, that's easy. When you're lending money to some other party that we have no idea about, typically unlisted, it might be another person. As you can imagine, it creates tremendous audit risk there's a whole bunch of SIS compliance questions we have to ask, but the big one really is recoverability. Is the fund actually going to get its money back? Look, I guess when it comes to actually what information do you need to provide us for the audit? Look, a loan agreement is critical. You have to have a loan agreement. A verbal agreement is useless. In fact, it's almost certainly going to get you potentially a qualification, like a SIS compliance qualification, maybe just a management letter, sort of a point raised in the management letter. But yeah, you really do need a legally valid loan agreement, spells out the parties, spells out the terms. And part of the reason for that is because we need to assess the commerciality of the loan. I have had an instance where the ATA came in and got upset because even though there was a loan agreement and everything looked right, they weren't happy with the repayment, the regularity of repayment. They weren't happy with the interest rate, even though we clearly demonstrated it was with a third party. And we thought it sort of stacked up, the terms aligned to the trustee actually provided third-party information that they could say, well, yeah, look, it aligns with what happens in the real world with commercial loans. ATO was still a little bit upset about it, and so we need that loan agreement to assess things. Another thing that can be quite, that we potentially will need is we need the sort of legal title over any underlying property. If it's a secured loan, we need to actually demonstrate that that's the case. Now, I guess the thing is, even if you're able to provide that, ultimately, we're typically not auditing the borrower. We're not going in, assessing their records. We'll look at the financial statements of the borrower if they're available. But at the end of the day, we don't know if their business is going to be a going concern. I mean, it may all look great, but for all we know, there's the business has like a central tenant or there's a litigation case. Like we don't know. And so ultimately, the vast majority of auditors, including ourselves, where these loans are material to the fund, we will generally qualify Part A of the of the financial statements. So essentially saying, look, trustee, we haven't seen anything wrong, but we're not putting our name against that loan. Generally, it doesn't result in a Part B qualification or a contravention report to the ATA because the valuation is fine. It's just ultimately we just don't know about its recoverability. Now, that's not always the case. There are some instances we've had where we do have serious concerns about the borrower for whatever reason. In that instance, yes, we potentially will do a Part B qualification and a contravention report as well. Yeah, so look, and I guess the only other thing I want to talk about with this is what happens if the borrower is a related party or a semi-related party. You know, the unit trusts with 3 or 4 individuals, and it's not related, you know, under the Part 8 associate rules of the SIS Act, and the fund is lending money. You know, maybe it has an equity investment in that trust. It's not related, but there's still a kind of a connection there. Look, as you can imagine, we really scrutinise those for arm's length, sole purpose, you know, gnarly. Yeah, it's a high level of scrutiny. There's not much you can really do provide that information that you know you hopefully already provided, you know, loan agreements and whatnot. And we may have further questions, but yeah, look, every different loan agreement is going to be assessed on its merits. So yeah, look, that's basically it. You know, hopefully that's been helpful. If you have any questions about this or other you know, technical concerns, you know, please reach out to myself or your Aquila audit partner. Thank you very much.